What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
Danny, thanks so much for being here. Welcome back. Been looking forward to talking with you. There's been so much action in the market. You've had some pain in some of these mega cap names that have been such a hallmark of people's portfolios over the last couple of years. And you've seen equal weighted and a broader market push, but there's a lot of concerns out there, despite what would oftentimes be thought of as a improving, better market.
Yeah, I'd say so. It's so cliche to say it's a stock picker's market, but it's a sector picker's market. It's a factor picker's market. And sure, it's a stock picker's market. The S&P year to date, and we looked at this the other day, has been in a roughly 3% range, which is the tightest range this far out. So I think we were at 36 trading days. It's the tightest range since at least 1980. We could probably go further back and look, but you get the picture. Since I've been alive, this is the tightest range the S&P has ever been in to start a year. And I think that talks about the inertia within the S&P and like what you're finding. And maybe this is the world we live in now, and this could be temporary, but money just isn't leaving the market. It's moving within the market. It used to be money would leave. I think part of the reason it's staying is, one, unemployment is still very low. Two, we're running, a 6% plus deficit. Arguably, the Fed is accommodative now and is planning to cut in the future. That's priced in. And you've got huge tax refunds coming. Now, I get there is, and then while all of this is going on, you've got random credit blowups. I know this MFS in London just blew up. You had Tricolor a few months ago. So you have these blowups happening. You have people really concerned on the private credit side. We have clients looking at buying like what we've been pitching and suggesting on the hedging side. Like we're seeing a lot of BKLN puts trade, which is a leveraged loan ETF. What we've been looking at in lieu of that is something like that. That's been okay. It's been an okay hedge. It's off the highs. It's something like KIE. So that's the insurance ETF. We have a great insurance team at Piper Sandler. They've done some work, and a lot of these insurance companies are investing these premiums they collect in private credit. So you might have the double whammy for insurance companies of, one, AI disruption. And that, whether or not that's true or not, it doesn't really matter. We're in this shoot first, ask question later, as far as like the AI theme. And two, you have like private credit risk. So it's like there's both sides of the AI trade that seem negative. Now, these are great businesses, and like maybe in 6 months, it's like actually insurance is a huge winner. They're able to underwrite a lot more risk. They're able to analyze a lot more risk quicker, and they could do with less people or the same amount of people, but people can be a lot more productive. Sure, but I'd say near term, that will not be the story. And the volatility is very low there. So that's where we've been looking on the hedging side. And we've been drinking your Kool-Aid, Nancy Lazar's Kool-Aid, playing the broadening out, like the long industrials, long materials, long even energy. And energy is an interesting long because it's a nice geopolitical hedge. There's a lot of stuff to be fearful of. And I think for the most part, we're seeing clients avoid the Mag 7, avoid larger cap tech, which is unusual.
What's unusual for the last couple of years.
Absolutely.
But now when you think about it, it's really hard to beat the market when the mega cap names are leading the way. So over the last couple of years, like you just can't get bigger than NVIDIA.
Right.
So it seems like, isn't this what we wished for? But it does seem much more painful from a psychological standpoint for all of us, and much more uncertain of a recovery and a broadening out than we've ever seen before.
Just to jump in on that, Stephen, the equally weighted S&P 500, it's just been up and to the right, making new highs frequently this year. So to your point, yes, I think in a lot of ways, it's what we wished for in terms of being able to beat the benchmark. But of course, the S&P 500 has gone nowhere.
Right. Yes, to your point, it's right. RSP made a new high yesterday. NVIDIA was down 4%. S&P was down. It's outperforming. It's the biggest outperformance again, like since we've seen to start a year, and mega cap or the RSP relative to S&P. And so maybe, and we got this question yesterday, maybe what's happening, I'm curious what you guys think about this as well. The argument is being made that anything with a really high margin, so especially in the information space, so software specifically, it's a very high margin space, that's going to be, have a lot, like the moats are shrinking there. And the lower margin space is going to be the winner in AI. And you can make the argument that maybe some of this consumer staples rally actually makes sense because they could theoretically get a lot more efficient. And while revenues probably aren't growing massively for a lot of these companies, they're pretty stable revenue, they could start getting much better margins on adopting AI and maybe more efficient logistics, whatever it is. I don't really buy into that as part of the why like the XLP has rallied so much. I think that's more a flight to safety, and less. It's not going to be AI disrupted. It might be an AI winner, but it's just unclear on where that goes. So we've actually been doing trades to fade the rally in XLP, but that is like that concept and that thought is a lot of questions. I'm getting a lot of questions there, like how to play that. And we've had people buying puts on like an IGV. We're a little bit both ways there. That's like where we've seen a little bit of two-way flow, some dip buying. And then there's a lot of just stay away. It seems like in the software space, we've had clients looking at Microsoft and then Service Titan, TTAN, as longs, and then otherwise staying away, some put buying. And then also a lot of questions about what's next. Like what are the next names to be disrupted? And that's a little scary too, because a name like Rocket had incredible earnings, and that 2 weeks ago was a disrupted name. And now maybe it's not a disrupted name. So I think that'll be pretty dynamic. You can make the argument that banks could be winners or losers. I think it's really unclear right now what will happen, but at the very least, productive people should be able to be a lot more productive going forward. And the optimist in me, and listening to Nancy, listening to you guys, would say, cool, your people are just going to want more stuff, and it's going to be easier to get people more stuff. And having these tools will create jobs, will create new industries and stuff we're probably not thinking about. And like the quantity of stuff like you guys are able to look at now versus 3 years ago it's widened, and same with us and things you can do. And that hopefully will continue. So you can put out better work, better content. You have more, you can be more informative, more value add to your clients and not have to waste your time on stuff you don't want to do.
You're exactly right. Historically, disruption leads to increased productivity. And I think we're all benefiting from it already. To your point, we've gotten so much more productive over the last couple of years with embracing kind of all these tech trends. But to your point on the market, I think you had mentioned shoot first, ask the question later. That seems to be the modus operandi for investors right now.
Yeah, I think that's right. I think it's like something clearly shifted over the last few weeks where I don't know the terminal value of a lot of these companies, so I'm just going to get out of them. And I'd rather own Caterpillar, which they're building the data centers. We have this huge fiscal push. We have the tax backdrop is very beneficial to them. I'd rather just get long in that name, and the software's been good to me. I can move on and just look elsewhere. And that seems to be what's happening. And there is some dip buying here and there, but I think broadly speaking, even like the Anthropic release, I think it was Tuesday, when they did that presentation, they showed we want to be integrated within your app, within your software company, which is good business for them too. That's brilliant. Why would you try to, if you're them, you want every company paying you. Why would you want to put every company out of business? That doesn't necessarily help you if their people aren't working and there isn't demand for your product. You can be like a layer within these companies. Now you're very important. You've got very stable revenue, and your TAM continues to grow as new businesses grow. So unless you're like more of the utopian, dystopian view in the next 10 years, none of this will matter, which I don't know what the trade is for. Nothing matters. So maybe it's long gold.
Danny, would you say, given everything going on with the market being pretty flat, but some big moves underneath it, would you say compared to last year, say, are people getting more active in the option space, or are people more on the sidelines than they had in the last couple of years?
More active. You have to be more active. Like this earnings season, and there's a index called VIX EQ, which looks at like single stock equity volatility within the VIX. So it's like the VIX is I think relatively high compared to how much the S&P is actually moving. We mentioned the range has been fairly tight, but this is very high. So this is saying that single stock volatility is very high. And that's where we've seen the shift and the change. We're less active on the broader index and ETFs and more so on the single stock side. And that's where the opportunity is. You're having such large single stock moves. And some of these stocks, so it's like logically, like some of these stocks are so big, like a Google. You get long Google, you buy shares and it goes up 4%, you'll make 4%. Whereas you can buy a near the money call, short dated, and there's a specific event, you can make 5 times your money. I think that math is continuing to be incorporated in people's thoughts. Hedge funds are obviously trying to drive returns, and that's a lot of our clients are hedge funds and institutions. And the way you do that generally would be using leverage, using options, catching the right catalyst and riding the wave. And while the S&P, again, has been chopping around, there has been trends that have worked. Like the best trade you could be doing this year, if you look at like the P&L of selling a weekly S&P straddle, obviously a very risky trade. That's been incredible this year because we haven't gone anywhere. On the flip side, you would do that trade and you'd be buying single stock vol against it. And that's been a great trade. So these dispersion strategies, while it's not priced great, it's continued to work. So that's where we're seeing clients a lot more activity. They're looking for cheap single stock volatility. We don't necessarily see as much as what they're selling against it, but that certainly is a place we've been active. We've been active in healthcare for sure because of all the potential M&A. And again, the M&A space in general has been heating up. And I think that's been in lieu of ECM actually, and their IPOs have been delayed. It's a catalyst-rich environment, which is great for options. And the catalysts continue to shift. I think it's also part of the Trump administration too. It's like things are changing rapidly. Good time to use options when things are changing. When things are boring, good time to write options, but not necessarily a good time to own them. And I think this is like the right environment where you're going to get really big moves. It's a good time to be hedged. And again, it's like it's a very weird time. It's also how important positioning is. If you think about NVIDIA reporting yesterday, if you would have gotten that earnings report 2 days ago and said, hey, you have a genie, he gave you that report, you'd be like, oh, I'm definitely getting long NVIDIA for this. I'd be super long. And stock was down 5% yesterday. So it just tells you people are clearly long. The momentum trade is long semi short software. That is the momentum trade. That got smushed yesterday, and we'll see what happens today. But that has been such like a straight up and to the right trade. That makes me think you're going to have some like pockets of, okay, time to move on. And the nice thing with options specifically is like they force you to move on because there's an expiry. And if you have a 25 delta call that goes to 80, you probably are going to do something with it. You're going to monetize, you're going to roll it, you're going to do something. And so that's, I think, also driving volumes and driving activity and driving interest. So I think I'm very optimistic on the outlook for the option space. But again, you're going to have to be creative. You're going to have to think second, third derivative on why things are moving, what the trade is, and then continue to be like, I guess, very like I think the people who make money using options are very just inquisitive and also overlaying what the market is pricing in versus maybe catalysts people aren't seeing.
What would you say are the events people are positioning for coming up?
Yeah, by the way, getting a lot of questions about the ISM. I think people are like very cautious on that. More so, we see trades more so on CPI and NFP than ISM, but certainly getting questions about it. The bigger, like broader trades that we've been seeing, long dated puts on credit related stuff. This is the private credit companies like the Blue Owls, BKLN. We've mentioned KIE. That certainly is there's not necessarily a catalyst for that, but we've been there. We've had clients setting up trades around the first week of April, last week of March. That's when Trump and Xi are meeting. So we've been setting up like hedges around that, a sell the news event. Some people think it'll be more bullish. So we've seen some chemical upside trade around whatever decision they come up with. The thought is that they would agree to buy some maybe fertilizer or something or soybeans from the US, and we would give them access to all our AI chips, whatever. Who knows what will actually come out of it. But those are seemingly the nearest term. And then March is also, we're going to get another Fed, and June is Warsh's first FOMC. So that's certainly on our radar. And then longer term, the midterms. And that's starting to come up more and more because I think the expectation is, and maybe that's part of what's going on with the market a little bit, is it's starting to price in a Democratic sweep and figuring out what that means. And then the last near-term catalyst, tax refunds. So we've had a lot of interest in more experience upsides like jets and hotels and cruise lines, thinking that's where that money will go. So looking at trades where maybe you're getting long that space for the next few months, with the biggest risk for the airlines would be anything happening with Iran and the US and Israel. And that's geopolitical risk. But that's why options are, I think, the way to play. If you want to play the things settle down plus tax refunds, long jets. If things don't settle down, jets are going to get smoked. If there's an oil spike, airlines will get killed temporarily. I think it's probably a buy the dip, but temporarily they'll get hit. And so that's the last sort of geopolitical is around what's going on with there. It seems like the vibe I'm getting, and from speaking to clients, and Jan, our geopolitical / energy macro analyst, something's going to happen. And the buildup suggests something's going to happen. And then if you look at OVX, that's the VIX of the oil, it's spiking, despite oil not really spiking. So that everything is telling you something is brewing. But when something happens, perhaps that's the fade, and then you start buying the stuff on sale. So it's all in the wash, and S&P doesn't move. Although today it's moving. Looks like pre-market we'll see if this sell-off lasts. The thing is, whenever I always say like the market's trading hedged, and when I say that, two things tend to happen. When you get a sell-off, fixed strike vol starts coming in, meaning volatility is actually dropping during the sell-off. So that's telling you people are selling their puts because they're already hedged, and that creates some market support. And even right now, we're up 30 bips off the low, and perhaps some of that this is Friday at 8:50 a.m., but perhaps some of that's just even pre-market, you can start selling your hedges. S&P is trading now, perhaps some of that. So it's just weird. I think market certainly trades hedged. there's all these different catalysts, all this different stuff to look at. So I think that makes people want to own S&P puts, but I think part of that is why the S&P doesn't do anything. So there's enough to be afraid of to hedge, and really you should be focused on the sector side.
It's definitely a catalyst-rich environment from a bunch of different angles. You have geopoliticals playing such a large role these days. Policy and politics is just off the charts in terms of its importance. But in the end, we are seeing, and we wrote about this week, the classic telltale signs, leadership transition of a rotation. You're moving from longer duration into shorter duration. That is what's going on, but it doesn't seem to be being received by the market the way you would expect because of all these other things.
Yeah, I think there is real concern on the job side, and no one really knows what to expect, right? If you look at XYZ, like they're cutting 40% of their staff. The stock is down again 80% over the last 6 years, when their staff was basically back to where it is now. Now they're creating more revenue, but again, I think the bigger concern with AI and job loss is going to be places that maybe have unproductive people. You can use AI as the boogeyman. Whether or not AI is actually taking their job, it doesn't really matter. And I think that's what's going to be happening more and more. Because why wouldn't you? If you have the cover of, we're using AI, but it doesn't really matter. Now, I think all companies have people, especially larger companies have people who are less productive than others. And you can use that as the boogeyman for the time being until we start seeing new companies build, and then there's this whole cycle restarts. Because I guess we haven't really had a employment correction in 20 years. Since 2015? I mean, you had COVID temporarily, but beyond that, and then it shot up way too much, and now it's like middling. And so we'll see. I don't know. For you guys, it's still the same, right? It's like play the broadening out, play the quality, maybe outside of tech names they're the names that people are borrowing money to pay them. Like these companies are borrowing money to pay Caterpillar, to pay this. Like NVIDIA's telling you that they're actually even like investing in the companies that are buying their product. It's a little circular, but
yes, we're still 100% play the broadening out trade and the cyclical tilt to it. So that's something that we think is going to continue. And I think it's been pretty amazing. At the beginning of this year, we put out a table that showed Mag 7 and how much of a decline you can get in the Mag 7 name and what the rest of the market would have to do to offset that in terms of how much it would rise. And we're basically exactly there. The Mag 7's down, the rest of the market's up. And so that's something that we think has happened and can continue. And I think what's going on now, even with rates, we're seeing obviously for the last couple of years, everyone was all focused about rates. Now AI's completely still in the show, but rates are still super important. And we're seeing the 10-year now fall below 4%. We're seeing mortgage rates fall below 6%. And that's going to be helpful to the broadening out trade as we move forward also.
I think the clients are aligned. I think that there's been enough worry to maybe that can help the market kind of keep lagging higher. But I always wonder, and I agree with Craig on the technical side. We've had a lot of good years in a row. Like maybe just this year will just be like a sort of what we're seeing, the S&P flattish, but you'll have really big sector moves under the hood. Like we were up 24% in 23, 24% in 24, 17% last year. I don't know. Like maybe we're just going to have a nothing year. In 2022, we were down 20 after up 14, up 30. So it's maybe it's like we're due for just kind of nothing. It's just hard. It's hard to me to see a huge sell-off with how big a deficit we're running, combination with Fed, tax refunds. It's just hard for me to see it's super bearish.
That's basically our call for this year, is that we're not going to see a whole lot of upside for the broader market. And a lot of that has to do with just PEs being so high already and spreads being so low, and it's being not a whole lot of risk left to be priced out. So I think we're totally in agreement with that we're going to see a big rotation broadening, but overall, we're not likely to see another year of double-digit major returns for the broader market.
Also depends where you look. Like those double-digit returns were over the last couple of years in the 20s were in SPY.
Yeah.
True. That's 100% true.
We're at a run rate where you could see that in RSP, equal weighted S&P.
Yeah, IWM is up 8% this year. It's 64% annualized. I don't think it's going to be up 64%, but yeah, to your point, RSP is up
almost 7%.
Yeah, and so that's 50% annualized. That's not going to be 50, but yeah, you could have a scenario where S&P's up 1 so far, S&P flat, and RSP up 10. Like, sure.
Same exact stocks, different weighting scheme.
And this is the first time in a while that people can't just lay into the Mag 7 and just let that work.
I think that's what's causing so much of the distress with talking to investors. To your point, the S&P is down 1% from its all-time high, and people are freaking out. RSP's at all-time high. It's definitely an unusual backdrop we're in today.
Yeah, I think doomerism, I've never seen anything like this since I've been working. And it's funny, so I started in '06, and when I started, people have been saying this is not going to last for another 5 years, just finance in general. Like the job, like none of it'll last. And it seems like there's more interest now than ever, and it seems like there's more exciting and cool things to look at and more tools at your disposal. But it just seems like everyone is so scared and negative, and unemployment's going to keep getting worse. And there will be changes, but it's like people adapt. And I guess I find myself cautiously optimistic. Maybe we'll live in a world where we can just get more. Is that possible? There could just be your what you demand will increase, just like you never knew that you needed to watch a show on your phone while you're walking to work or whatever. You never know you needed that, but I guess maybe you do. And so maybe there'll be other stuff you didn't know you needed, like taking a helicopter to work. Like maybe now you're like, oh, I can't believe I used to take the train. Now I'm in a helicopter.
We're basically a pilgrim on that subway, right?
Yeah.
Danny, as you always say, nobody's ever made money betting on the end of the world.
Exactly right. Like I've seen that too. It's like you made a lot more money just being optimistic. Temporarily, you can make a lot of money being pessimistic, but generally, I think it was the guy at Appaloosa, whose name I'm blanking on, David Tepper. He's saying trees grow.
Yep.
And yeah. So I think that hopefully that continues, and we'll see. One last thing, we've also been very active in the non-U.S. markets, especially South America. So Brazil's been an area we like on the long side. Ties obviously to commodities, which have been working, but beyond that, Flavio Bolsonaro, as he pulls better, that should be good. And plus, they're going to be in a cutting cycle. So a lot of things to like there, a lot of cheap stocks. Obviously, there's always risk in investing in emerging markets, but it's been a laggard over the last 10 years massively. And so maybe there's an interesting place to play catch-up trade.
Emerging markets are our favorite region for this year. And that plays out to the broadening cyclical upside, that whole trade.
I like it. Outside of China, China's always hard. It's just hard. It's like that's always a trade, you can trade it, but I wouldn't stay there.
This is exactly where I wanted to go before we ended today, was get your thoughts talking to investors about other than the U.S., outside of the U.S. trade, and what's been the reception on that. Because for us, we like emerging markets. We like outside of the U.S. That is your classic cyclical acceleration playbook. So what, after 3 years of US, maybe even 10 years, because you've had this kind of secular growth move, what have been investors' thoughts on that? Because I feel like that's also been a place where people have been burned over the last couple of years.
I think they're open to like an EEM, like the emerging market ETF, certainly Brazil. We don't really see we see tactical trades around China, but I don't think anyone's buy and hold. Europe's interesting because it's been a great performer for what we see. I think it doesn't matter what, I think people just we're not seeing the upside activity in Europe, despite how well it's done. We just don't really see a lot of interest there. We see more hedging interest, playing the fade. So maybe that means it continues, but I think people have a really hard time believing Europe's going to be a secular outperformer relative to the US. So we just don't see it. But India, we have clients who are nibbling on. Korea, absolutely. Japan, we like. In Brazil. So it's like there are emerging markets that clients seem to be open to, even Mexico, despite what's going on there. People like it, but it just seems like it's almost like you got to pick your battles. And for whatever reason, Europe, it trades well. It doesn't really go down. Like EFA, developed markets, ex-US, it trades great. We do not see, maybe there's other clients or they're doing it we only trade US listed options. Maybe they're trading the European options. We don't see the interest, so perhaps it keeps going. But I'd say, yeah, a lot of clients are on the same boat as far as EM ex-China.
Has Kospi gotten a lot of attention? Because that chart's been...
Yeah, EWY is what we would trade, which is Korea, and it's 50% Hynix and Samsung. So it's a semi-play. Mm-hmm. But they've also, I think, encouraging individual investors to blow themselves up. So that's usually temporarily bullish. Honestly, I'm looking at this chart. I buy puts for like a trade for the next few weeks. But yeah, long-term, sure, it's fine.
Great. Thank you so much for your time today, Danny, and your insights. Really look forward to it. Got to have you back again soon.
Sure. Some of the stuff will probably be right. I feel like I was all over the place, so that'll be definitely some of it will be right.
Awesome. Thanks so much, Danny.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.